15th, the middle of the second quarter, the middle of May, and an opportunity every Sunday to have a week in review of where the markets have gone and the week ahead and where we're likely to go. And before we kick off with our two distinguished speakers, I want to just acknowledge over the weekend here in the UAE the passing of the former president Khalifa bin Zayed and the appointment of his brother as the new president of the UAE, Mohammed bin Zayed, which should pass with relatively seamless change, as the current president, the new president, has sort of been carrying out those duties for a number of years. But condolences to all our Emirati friends and to the family who have lost their brother. Let's kick off this morning in Washington, D.C., bright and early for both our speakers. We are late, depending on which way you look at it. Let's start with Dr. Sarah Vashuri, founder and president of SVP Energy International. Sarah, we've been kind of caught in this tug of war between supply concerns versus demand destruction. We ended last week with oil prices firmly on the top end of that range that we've been bouncing over above $110 on Brent. But nonetheless, this sort of ping pong between these two extremes seems to be bedded in. Where are your thoughts this mid-quarter as to which of these two stresses will win out?
Thank you, Sean, for having me. It's a pleasure to be back to this event and program. So something that is very important, Sean, and I like to bring everybody's attention, is that there is a lot of hype about oil prices, lack of supply, but the reality is that we really have lack of refinery capacity. Especially if you look at US, we had within the past 2-3 years, we had about 10% of US refinery capacity shrinking. So the problem is really the problem of products, not so much crude oil. Of course, the whole market is tight, but the real issue that we have now is the product, especially that US is going and the whole world through the driving season. And what we think is that for US consumers paying or having less $10 per month less in their pocket, it will not change their driving pattern and behavior for this season. So it's really an issue of refined petroleum products and fuel for driving, diesel and gasoline. They are way higher, their cracks in compared to crude oil prices. And for some strategic areas in the US, like East and Northeast, some of their, or like we could say a big portion of their import was coming from Russia, that has been now banned because of the issue with Ukraine-Russia issue. So it's really a product issue more than a crude oil. And also China still has its ban on export of refined petroleum products. So I would say that yes, the prices will still stay strong, but the real issue more than the crude oil is refined petroleum products.
Let's welcome Dr. Aldo Flores Quiroga, a former Deputy Secretary of Energy for Hydrocarbons at Mexico's Ministry of Energy, sitting in Mexico City. Dr. Aldo, where do you sit on your views on this tug of war vis-a-vis supply concerns, Ukraine, Russia's invasion of Ukraine, the potential for disruption of great scale there versus demand destruction and this seesaw between oil prices?
I think that we are in for contraction in demand toward the second half of this year or the first half of the following year. Why? Because we have begun this cycle of rising interest rates, and it's very difficult to think that it will be a soft landing for the U.S. economy, and for that matter, for the Atlantic economies. And that should have some correction in terms of the demand growth that we've been seeing, even though we're coming out of the COVID pandemic apparently. And of course, we still have the problems in China and the like. So it seems to me that it's still an environment of extreme uncertainty and volatility. And we will be in that mode for a number of months. And if I may, I would just add that this is a environment of a very disputed narrative, both in terms of politics and economics. There are many things, many factors that we have been taking for granted for a while that are now being disputed. So this all is affecting how both supply and demand will be behaving. And it's really difficult, at least in my view, to make very certain statements about how these two variables will move forward. Then again, the most where I will venture and double my bets, double down on my statements is that demand will not grow as fast as we saw during the coming out of the COVID pandemic.
Sarah, you obviously identified where the real crux and the pain might be vis-a-vis the oil, whatever one thinks of $100 oil, crude oil, that is. You could certainly think it could be a lot higher, given all of the challenges to the likes of Russia and Saudi Arabia, although thankfully at the moment there is peace or ceasefire in Yemen. And so Saudi is not as stressed as it was, perhaps, at least for this brief period. But looking at the products and the distillates and the refinery shortage globally, but also in the US, what is the immediate solution for that? We saw the US government trying to solve the high crude oil price by releasing SPR. What is the solution, if there is indeed one, for the great pain, which is really on the consumer end for retail refined products?
That's a good question, Sean. I think instead of putting pressure on OPEC, which I think it's a wrong button to press so much, is that maybe U.S. administration or someone in the U.S. could pick up a phone and call Chinese and talk to China and see if they would agree to remove, at least for temporary, the ban that they have on their export of products. If China would allow some of its teapot refinery and refineries to process at higher quotas and export some product, that would have an immediate impact on the product market, because as of now, for at least this season, the only available capacity that could be added to the market would be from China, Chinese refined petroleum products. Otherwise, we could wait for at least next year, 2023, to wait for new additional refined petroleum capacities that are coming into the market. And you also, and all the very much I agree with him. He mentioned about the uncertainty in the market. We have Chinese demand that now part of it is being under lockdown. So there's a lot of uncertainty, but it seems that the whole market is focused so much on crude oil and OPEC production, but the inventories are low, obviously, for crude oil, but much more so for refined petroleum products. And there is a huge gap between the prices and the cracks. If you look, there's really a high demand for refined petroleum products, especially, I mean, looking at it from US perspective, going to a driving season, the demand is going to increase in the coming month for certain fuels like gasoline.
But Sarah, on that point, the US driving season, obviously you're sitting in Washington, that even at these price levels, they're not having an impact on consumption.
On the US driving behavior, because again, like when we are looking at crude oil demand in general or natural gas, there's other industries, other issues that could have impact. But just looking at gasoline demand or jet fuel, diesel in the United States, especially for drivers, gasoline, yes, the prices are really high and people might drive less, but it's not going to have a huge impact because, again, like if you look at that estimate, how much is that saving or how much people have to pay more is not that much. It might be like $10, could be like few coffees, per week or month for people. People still like to travel, and they're still traveling a lot, looking at least hotel or Airbnb bookings. You see there's not much. So people are still in a mood of traveling. So it might maybe not growing as much as last year, let's say, or during the time of lower gasoline prices, but it's still the demand is strong. It's going to be strong.
Dr. Aldo, there lies the problem, isn't it, ultimately, that the Fed faces and central banks in general, that diesel or gasoline at record high prices are only one of everything that's at record high prices, and yet demand is not easing off. The Fed and others have no choice, it would appear at this point, but to try and kill off demand, as it's the only solution in which to fight inflation from bedding into the economy.
Yes, and there is not a perfect, but there is some correspondence from historical experience. And if you were in 1980, 81, thinking about these things, people were expecting, thinking of the price of oil, $50 prices. At that time, the price was around 38 or something like that. So the expectations were that prices were going to remain high and increase from 38, 34 to 50 by 1985. What happened was that the Fed started to raise interest rates in a very drastic way. And we had at the same time a demand correction or a recession beginning in the US, which eventually was combined with a rise in supply in the market. So I bring, which of course led to a collapse in prices. So I'm bringing this up not to say that it's going to be exactly the same, but right now we are, and this is why I raised the issue of narrative, we're probably too naturally focused, I mean, it's understandable, on this high price situation, but it won't last forever because, well, as we've said before, nothing cures high prices like high prices, oil or refined products prices. And we're going to see sooner or later this type of correction going on. So to bring this issue again of narrative, this is what concerns me right now. It's a very difficult moment to build a definite narrative of what's going to happen beyond the next few months, because so many things are happening. I was checking, speaking of refining, the projections the IEA was making in 2018 in its oil report. And by now we would be having a surplus, a significant surplus in refining capacity. Not at all the situation that we have now today. And what changed? Well, COVID, that forced the closures of so many refineries. And second, the fact that Russia has been under sanctions, and of course the ugly situation between Russia and Ukraine and its geopolitical implications. So if you bought the narrative in 2018, then you would not be much inclined to invest much more in refining capacity. And in fact, as we saw,
nobody did.
Exactly.
Except here in the Middle East.
Exactly.
If Aldo, just to follow up on the point of the path that I think we can see clarity on to a certain extent, at least the Fed's strategy for 2022 will be a series of chunky rate rises to get to, let's say, 2.5% on the Fed rate. They've declared as much. I think that's baked in the cake now. Where they go above 2.5, of course, that's the big question, whether they have the bottle for that. But ultimately, just 2.5, what does that mean for Mexico, for South America, as the Fed essentially tries to drive the US economy into the ditch a little bit and raise rates and strong dollar at the same time? What does the history tell us of what the future looks like for Mexico and your South American neighbors?
Well, the Mexican economy lately has been less so, but it's usually synchronized to the US economy. So an American recession spells a recession for Mexican markets. For South America, there's a connection there, but South America is now a little bit more diversified, exports more to China and exports more commodities. Mexico is a manufacturing exporter. So this environment of high commodity prices does benefit South America much more. Mexico actually is also, in terms of monetary policy, following pretty much the Fed. Not much of a choice there. So this is also a recessionary environment, and the Mexican economy has been in that sort of recession. So it's more likely than not that we will see, in my view, something that is not a soft landing. It will basically be a recession period to bring down inflation.
Well, Sarah, maybe the equity markets are telling us as much, as they've had their longest decline in, I think, a decade. But I want to just obviously move across to Europe. Sarah, the biggest story in the world continues to be the Russian invasion in Ukraine, although we've got through 15 minutes of our conversation not really getting sucked into that vortex. Of course, it's a very, very big one. I wonder your thoughts this coming week, this coming day, actually, and May 15th is the day in which a number of sanctions from the European Union and the US start to bite a little deeper, making it more and more difficult to trade Russian commodities. Your thoughts on the outlook for the impact still to be felt from the Russian invasion of Ukraine?
So I like to distinguish it because following up with what Aldo said, when we are talking about impact, we are talking short term or long term or medium term. So looking at this year, obviously things are a bit bleak. Next year, because of, again, all these Fed policies, recessions, the demand could be lower, more production from other countries like US. But looking at this week, this day that you are talking about it, obviously, if you want to compare the pressure on Europe, the pressure on Russia, Europe is going to have harder time, obviously. Russia, even though that some of their export has been cut off, like crude oil production, or they have lost some of their exports in refined petroleum products, but because they're selling their oil and liquid at higher prices, still they are making kind of similar money or similar revenue as they were making previously, even though that they're offering discounts. So for Russia, the cost has increased, obviously, and it's going to be increasing, especially the investment cost in the medium, longer term. But in the short term, Russia is still making the revenue closer to what it was making. For Europe, it's going to be harder, especially if you go through winter. Because again, we are focusing and talking about oil, crude oil prices, but comparing that to natural gas prices and also thermal coal, the prices of coal and natural gas are really high. Comparing again US prices versus prices in Europe, there's a huge gap, which shows the huge, the very big shortage that obviously Europe is facing. Molecules travel far or close. So if Europe is going to kind of substitute Russian oil or even gas, these molecules are going to just move around. So that gap is going to feel wherever it is in the market by Russian products. Now we are having like Russian oil going mostly to Asia, China and India purchasing those discounted oil. Obviously, they cannot at the current prices, the discounted $30 per barrel oil. It's important for their economies. So the Russian molecules might end up in Asia as
well, they are already. Obviously, we're seeing India and China enjoy very significant discounts. But Aldo, one of the big questions going forward now, as we are into the third end of the nearly 3 months of this invasion, the sanctions start to be executed and more become discussed, is the union, the sort of solidarity of holding bodies together. So the European Union is trying to hold its political body together with moving towards oil sanctions. OPEC Plus is trying to hold its organization together of 20 odd countries, of course, principally Saudi Arabia and Russia, into the same, keeping that union together. I'd welcome your thoughts on the stresses that these different unions face and your outlook for them.
I was thinking that, to stick with my story on narratives,
yeah,
narrative has moved from cooperation or collaboration to confrontation, on many different grounds. It seems to me that the resolve to cooperate will be longer in Europe because there's a clear and present danger there. And it will not be unanimous. We're already seeing some examples of countries that are having a hard time thinking along the lines that the European Commission has been proposing and the like. But I see there much more cohesion. Where it's not so clear to me, it's how it will go on the producing side, for how long OPEC Plus will work the way we have seen it.
Well, if we just look at the purpose of OPEC Plus, which comes to its current supply agreement, 430,000 barrels every month till August, and then expires in September. What would be the purpose thereafter? What would be an agreement that they could come together around, or would need to, in order to stabilize the market, et cetera, when the market looks very different now than it did when this agreement started? What would be their purpose? Aldo.
I didn't hear the last part. There was some.
I was just curious your thoughts on the outlook for the OPEC Plus group, which of course Mexico is a part of, although somewhat reluctant in ways. But what would be the outlook beyond September when this current agreement expires? It strikes me that the purpose isn't obvious like it was when it started 18 months ago.
Yeah, but remember that in this environment of uncertainty, there's still an incentive for the group to keep working as they have done, monitoring the market and the like. So the question here is, we're seeing some shift in supply patterns with Russian oil being redirected to some other regions. OPEC Plus will, so some of the members will likely refocus on other parts of the planet. The narrative will continue to be one of stabilizing oil markets. And we are not out of the turbulent times that's began with COVID and before. So I think the incentive is there for cooperation, but it seems to me that some of the adjustments will have to differ because the narrative will be moving more to stability as opposed to recuperating some modicum of reasonable oil prices in the market, which was what we were talking about in 2020, right?
And I think they will also have to get their alignment around quotas and production capabilities. At the moment, they're going every month more and more out of alignment, and we don't even have Iran back. Let's go to the survey question before maybe just touching a little bit on the outlook for the Iran nuclear talks. The soaring dollar is propelling the global economy deeper into a synchronized slowdown by driving up borrowing costs and stoking financial market volatility. Do you agree or disagree with this statement? That we haven't talked about it much, but ultimately the added big weight on this is the soaring dollar, because of course, most of the world consumes record high price commodities in US dollars. Dr. Serra, one of the issues that have obviously been part of the oil markets for some time has been the outlook for the Iran nuclear talks. They look, at least at the moment, I would say quiet, eerily quiet in some regards, which makes me think there must be something going on in the background. But what are your outlook at this point, mid-second quarter, for the outcome of the Iran nuclear talks? Is there any reason to be still optimistic that they can arrive at a destination?
It's very hard. I don't have a global, I don't have a crystal ball to predict that. And it's harder than oil market to predict the nuclear talk results. But in terms of volumes, if we just want to just look at barrels, something that Iran did is that they could restore some of their production capacity that have been lost during the years of sanctions. So they, according to their own claims, their production capacity has reached to pre-COVID levels, and they are ready to increase production. And that's what they recently said, that if market needs, we are ready to expand our export. They're already exporting close to 1 million barrels per day. And what they see is that they're trying to using this redirection of oil export, because as we just discussed, that Russian oil is now moving more toward China or India. We see that some of the producers, OPEC producers like Iraqi oil, going mostly to Europe. So Iran is trying to somehow leverage this condition by kind of sending signals or messages to Europe that if you want to substitute Russian oil with sanctions, Iran is ready to export more. But in terms of political side, are they going to reach to an agreement or not? It's really hard for predicting. There's not really enough positive signals so far coming out that indicates there's going to be a deal soon. And then we have a midterm election in US. We have to see who are the next, which party is going to rule the Congress and Senate next term. Those are all indicating factors. And also the demands Iran has, some of the political demand that they have might not be very much feeding the appetite of people in Washington, DC politically, and also US allies. But something that here, I think it's important, Sean, and Iran has a lot of that, is fertilizer. Something that we have to talk about it, because now we are facing a food security, having just India putting a ban on export of wheat. The price of food is increasing. Obviously, the feedstock for most of these fertilizer factories is natural gas. In Europe, even before the war began, many of these fertilizing factories reduced their production. Some of them have been shut down now during this high gas and energy prices. So we are moving toward some months of not just high energy prices, but or high fuel or high electricity prices, but also very high food prices due to fertilizer. And something else that Iran might again start leveraging that is that Iran has a lot of petrochemical capacity and fertilizer that was traditionally exported to China or India. And again, is like how much capacity we have in the world for producing fertilizer for the need of the global agricultural needs.
Let's give the last word to Aldo this morning, as we gave the first word to Sarah. And the survey result is, I suppose, an overwhelming agree there. Just Aldo, looking ahead, the week ahead, obviously the very big dominant story, in at least in the privileged world, perhaps, is the collapsing U.S. stock markets. But it's sort of an narrative that's overwhelming nearly most other things, given how important it is in particular to the US economy. How do you see, what's your outlook for the week ahead? The China slowdown continues to be, the Shanghai, Beijing lockdowns. What will you be watching this week coming?
I will keep watching the figures on, not so much on the stock market, although which will definitely have an impact on perception of wealth. But on US economic figures, I am very interested in seeing how the European governments continue to shape their energy policy and their agreement with respect to Russia. This idea of consumer cartel, which I don't think will move forward, but it's still something that frames the way the region might be thinking about the course of energy cooperation among the OECD and then the West in general. And of course, what decisions China makes regarding its lockdown, which seems to definitely not be going according to plan. So those three things.
And of course, next door to China, which is North Korea, which is also, even the leadership there is acknowledging a very stressful situation in a country where there is no vaccines and an elderly population. That could be quite a bad cocktail. I think the other thing I would just draw a note for the week ahead is the decisions by Sweden and Finland to join NATO have emerged. I mean, that we knew that was coming, but sort of the final indication and commitment has surfaced over the weekend. And Turkey is putting some obstacles in front of that. You would imagine those obstacles for Turkey can be overcome. But what will that mean for this conflict in the Ukraine, in the whole European front with Russia? Does this trigger to further escalations, or does the status quo that we're seeing now maintain? I think there's some velocity there still in the geopolitics of Europe that could swing this all into another scale. I don't think we're out of the woods of that yet, and I think that's worth keeping an eye on in the coming week. But for now, we must Sorry, Aldo?
Completely agree. I mean, one thing to figure out is what does a technical military operation or adjustment, I don't know what now the term that is being used, that Russia is using with respect to Finland, what will that mean? We don't know.
Yeah, well, Finland has very dark experiences in the past with facing off Russia. I'm sure that's still very fresh in the memory, although it's 70 years ago. But nonetheless, they lost 10% of their territory at that time, which looks like what Ukraine is suffering at the moment. Dr. Aldo Flores Quiroga sitting in Mexico City, thank you so much. And Dr. Sarah Vashuri sitting in Washington, D.C. Both of you, I know time zones completely out of sync of ours. And so we're very, very grateful that you have spent this half hour with us and continue to return to the Daily Energy Markets podcast every month. It's great to have your voices, very unique, and bring us very much appreciated insight. So thank you. Have a great day and a great week, and we'll catch up with everybody every morning at 10:30 UAE time. All the best.
Thank you. Likewise.